Well, hi there, my name is Jason Ayers, CEO of the Croft Financial Group and a member of the Investment Review Committee. On behalf of the committee, thank you for taking the time to watch our Portfolio Manager's Brief for January 2022, and of course, Happy New Year. Well, it was a wild December for the stock market as investors weighed the risk of Omicron. However, after a rough start to the month, stocks bottomed late December and rallied through to the end of the year as evidence surfaced that the new variant, although more transmissible, was proving to be less severe. As reflected in this chart, North American equities had a tremendous 2021, propelled by strong earnings growth, while emerging markets continued to underperform as China's economic outlook deteriorated. So far, January is off to a challenging start for equities and fixed income, as the U.S. Federal Reserve kindly reminded investors on January 5th that inflation has been pushed higher and remains well beyond expectations, suggesting that they may have to act sooner and more significantly than expected. As this chart reflects, U.S. headline CPI came in at 6.8%, a 39-year record, with durable goods, which includes appliances, computers, and vehicles, up a whopping 14.9%, an all-time high. And with Canadian CPI not far behind, investors have been preparing for central bankers to step in to manage this in three ways. 1, modestly raising interest rates over the year. 2, stopping the purchase of treasuries or their asset purchase programs. And 3, selling treasuries back to the market or reducing their balance sheets. Now, all three of these measures can influence interest rates effectively, and as we see here, 10-year Treasury yields have spiked sharply on both sides of the border, forcing bond prices respectively lower in anticipation. Now, what investors weren't expecting to hear in the January 5th press release was that all three strategies could be happening at the same time and sooner than expected. And therein lies the risk to both the fixed income market and companies dependent upon borrowing costs being low to finance growth and development. As such, the rate-sensitive, debt-heavy tech sector is suffering the worst out of all major indices year to date. Bigger picture, our expectations are that while the virus remains a wild card, we should see reduced restrictions with lower economic impact due to the success of the vaccine and lower severity of the new variant into the second quarter. We are optimistic that policymakers will pursue a gradual phase out of fiscal and monetary support, but investors will remain headline sensitive and markets volatile. Inflation should decline but will remain over target, with the biggest risk to the market being the possibility of a more aggressive and faster tapering on the part of the central banks. And as indicated in last month's brief, as the economic recovery continues, we expect the pace of growth to slow down as bond yields increase and equities climb modestly. Our strategy has remained relatively unchanged from last month, with the same focus on quality, reduction of interest rate exposure, and purchasing companies at a discount. Our move towards quality should serve our investors well in a flatter equity market and a higher short-term interest rate environment. And we continue to be mindful of the impact increased interest rates will have on tech company valuations. While we are paying close attention to the headlines, we are viewing this current volatility as short-term noise until evidence suggests otherwise. We'll continue to actively use option writing strategies to enhance portfolio income, taking advantage of the implied volatility premium factored into option prices due to the ongoing uncertainty. And once again, we are prepared for a grinding market that will continue to increase, but at a slower pace. In closing, we will continue to keep you updated as market conditions change and our outlook adjusts. And as always, for more insights, please check out our latest research report entitled The Last Wave, posted at www.croftgroup.com. Now remember to be good to one another, stay safe and healthy, and on behalf of the Croft Financial Group, here's to a healthy, happy, and prosperous 2022. Thanks for watching.